Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, Jim, here we are. Another Friday, another week in the market, and it's always been interesting, hasn't it?
And our listeners around the globe have been listening, and they have several questions for you today, so let's just get right into them. Our first question comes from Jessica. Hello, Bob and Jim. I'm curious to know how a stock market crash may affect the Canadian housing market. Are they tied to each other in any way? Does Bob see the price of Canadian housing coming down anytime soon? Thanks for your time, Jessica.
Okay, Jessica, thanks. It's a timely question. Yeah, we're not in a crash yet. We've got enough upside speculation going on that there will be a correction, a hit to the markets. And if this is indeed a cyclical peak, it would certainly put a depressant on residential house prices. Although we've got the remarkable thing is every time something goes wrong in China or Hong Kong, they immediately come and start buying in Vancouver and also in Toronto. So, but in the housing bear market in the United States after 2007, there was enough downside pressure then that the bid from Asia was ineffective, but it didn't mess things up too badly in Vancouver. So a cyclical bear market and a cyclical contraction would certainly dampen some of the speculation in Canada's residential housing market.
And Russ K. from the wealthyhomeowner.ca, who talks to us every Tuesday, says his data tells us the Canadian housing market has started to cool since September. So he said, don't believe what organized real estate tells you. It's not the best time to be going out there and buying a house.
Oh, well, yeah, there's been pretty, things are quite high relative to, if you look at some of the house prices indexes in the States, and maybe certain areas, the average house price can be $375,000, and the average house price in Vancouver is around $1.3 million. It's a strange world out there.
Question from Bruce Hubbard. Hello, Bob. Love your work. My question is, when this everything bubble blows its top, where are you looking to hide? You do have a wine cellar, don't you, Bob?
And the wine cellar. I like that one. Oh, again, if and when the cyclical change comes in, there are two places where one can get a good return from, and that is in a post-bubble contraction. The real price of gold typically goes up, making for a unique bull market in gold stocks, but it'll still trade off the big market. But, like from the low in gold stocks in 2018, which we called, and then called for a new bull market for the gold sector, and beyond that, said that it would likely outperform the S&P. So we looked at the GDXJ, and to the speculative high in July, the gold stocks outperformed the S&P by 2.2 times. It was really rather good. So this will be the case. This correction in the gold sector will continue, and we will, of course, identify the buying point when it comes along, hopefully. And then the other one is that you don't want to be in any low-grade fixed income. You'll just get killed. But an ideal place would be 3 to 4 year good-grade corporate bonds, U.S. You're going to get a better return out of Treasury bills, which are down damn near to 0%, and you'll get a better return, and with the shorter maturity date and all that sort of stuff, you might even enjoy a bit of price appreciation as well. So, yeah, there are two places, gold sector and 3 to 4 year good corporate bonds. Again, it's up to the individual.
A question from Justin Lee. Bob, inflation bugs often cite the Weimar German government as their go-to model for the global financial system, but didn't the Weimar government just literally print paper that had no underlying asset or debt to back it up? It cost 1 billion marks at one point to buy a loaf of bread. I'll point that out. And is the Fed's excessive intervention just a drop in the bucket compared to all that private or non-U.S. government debt money creation out there? And that's denominated in dollars and very prone to a huge deflationary implosion that cannot be controlled by the central banks. Thanks, says Justin.
Justin, you got a good handle on it, yeah. Germany, after the First World War concluded in 1918, was, devastated, economically and politically and morally. It was a bad time. And then you had the Weimar government, and there was the credit market in Germany was virtually non-existent. So they then could take straight to printing currency, just like they did in the French revolutionary inflation in 1797. They just get the old printing presses going. But here's where some of today's inflationists seem a bit confused. Of course, they're ready to say that the U.S. dollar is going to go to zero and gold's going to go up and it's going to be dreadful and all that sort of thing. But if you take a look, and there was a study done on price items during the Weimar inflation, and if you were in gold and in the stock market, you performed somewhat better than the inflation rate. So, but what you have with the U.S. Financial markets, it's the world's financial center in New York, and you have a huge credit market. And the inflation that is on now, of course, is driven by or accompanied by huge credit expansion. And there is absolutely no way that the American financial system can go to printing currency the way it was done in the Weimar inflation. Now, also, if you read about that horrendous inflation, there were two economists in Germany at the time, I forget their names, but they each pointed out when you took the rate of inflation and the rate of price change and deflated it in real terms, and they said that there wasn't enough money being put out. So you always got somebody who will support the nonsense, and then the mood changed. The policymakers just said, well, this isn't doing us any good. So they went to a mark based on the price of rye grain for a bit, and then they just stopped printing, and that was that. So the other thing that we've seen recently in the U.S. is some of the inflationists, and the warning is that all of a sudden we're going to go into hyperinflation. No, it doesn't happen all of a sudden. They would have to destroy the U.S. credit markets and then go to printing presses, as in Weimar, and I don't see that happening. And Justin, nice question.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, Michael sends this note to us. Jim, I marvel at the number of excellent commentators and interviews you have every week on HowStreet.com. Thanks so much. I have a short question for Bob. Is it time to short the market, particularly the Russell 2000?
Yeah, shorting this is like standing in front of a huge number of buses coming at you. We have called for the rally out to around January, and then a few weeks ago said that it's going to go further. And what you have here is that a standard rule that we use is that, one, you want to see the momentum roll over. And on the Russell 2000, it has. Then the next step is you want to see it take out a key low from a while ago. There was one in the middle just a few weeks ago. So you want to see those taken out, and then perhaps the next pop-up, and then that would be the one to short. My colleague Ross Clark covers the Russell quite closely, and it has been fabulous. And the interesting thing is always this, that the small caps from the middle of December and into January can often outperform the big caps. And in this one, they just kept going. So it's been an outstanding trade, and we're getting technical successes on it now, and over the next little while, we should get what we call a sequential sell. So the advice is sometime it'll be a short, but you want to do it with the least amount of damage potential, and that would be after you've taken out a kilo.
Michael has a second question for us as well. The financial press reports that inflation is on the way and investors should prepare for the imminent great cyclical rotation into commodities. Uranium, agriculture, oil are increasingly mentioned. Bob, if the equity markets crash this year, then will commodities crash also as they have in previous crashes?
Yeah, Michael, I think you're on the right track there. All I do is stay with financial history, and you get a decade or so of huge inflation in tangible assets, commodities, and wages, and CPI, and all that sort of stuff. And then you go into a period of inflation in financial assets, which we have been in. And you just take a look at the German 10-year note going down to damn near minus 1% negative. Never in history. So you have had extraordinary inflation in financial assets. And then you've had, this is now the sixth, this really was, 2007 was a great bull market. But there were some of the characteristics of a classic bubble missing, such as 1929 or 1873 or 1720, all of the great classic bubbles. And the pattern has been, and this is number 6, that once the speculation in financial assets is over, everything deflates except for the real price of gold. So, good question. We're watching for excesses in like base metals. Lumber has gone crazy, over $1,000. Amazing. Straight up market with exceptional things going on. And some of these others, I looked at vanadium and cobalt the other day, still going up. But the leading groups such as copper and the other base metals, even I just looked this morning at crude oil, and it has had a terrific swing from being unbelievably oversold in March with that panic to really get kind of overdone here now. So I think the story about inflation coming back, they're all thinking about the 1970s type of inflation, and I'm going to remind us all of the classic economic definition of inflation is an unusual expansion of credit. And then that expansion of credit, when you're in a decade of when it's in hard items, then you've got inflation against that. But then when you're in a period of inflation in financial assets, it's the same thing. You have inflation of credit. So inflation of credit is always there, and it ends up being associated with, at one instant, real things, and another decade, financial assets. And all I'm going to stay is with the history is that once the inflation in financial assets is over, then you're into everything deflates. So, thanks for the question, Michael.
We have a question from Kathleen, and even before I opened it, I knew there would be a musical reference in it because she loves to bring along a song that goes with it. Yeah. Kathleen writes to us, "Hi, Jim and Bob. Wow, companies are now leveraging to buy Bitcoin rather than buying back their shares or reinvesting in the so-called V recovery. The current Bitcoin mania reminds me of the movie Gold Diggers of 1933. Great movie, by the way. The movie opens with Ginger Rogers singing, "We're in the money. The sky is sunny. Old man depression. You are through. You done us wrong." She goes on to sing, "Let's spend it, lend it, send it rolling along." Well, Kathleen says that part reminds me of Fed quantitative easing and the stimulus checks. Bob, how long can this Bitcoin mania last? And can it be the straw that breaks the camel's back and crash the markets as the Ziegfeld Follies marches along?
Yeah. Yeah, Kathleen, thanks for the reference to one of those wonderful musical movies. And there is another one. The lines go, "Gold, silver, and gold, all you can hold is in your hands," or something like that. So, yeah, there were a series of movies about that then in the Depression when people were really out of money. I mean, circulating money just appeared. The Federal Reserve was buying bonds like crazy, dumping cash into the markets, and it didn't matter because velocity went all to hell and you had the deflation run, and there was nothing they could do about it. So, Bitcoin, unbelievable. All we do is trade the excesses and advise our subscribers on the excesses and just see where the hell this thing's going. But, the other one that was great was the GameStop thing was just absolutely extraordinary as well. So you have outstanding individual speculations going on, but within this, your senior indexes like the Dow or the S&P, they are at speculative levels, although the action in those looks tame compared to some of this other stuff. But the whole market is highly speculative, and people should begin to get cautious in here. And the straw that breaks the camel's back, yes, I think in retrospect you can always look and see, and the media will always put a story on why it failed. Like in England in 1929, there was a very successful speculator. Hatchery was his name, and he was attempting to put together two major steel companies in England. And early in 1929, he had all the promises, the loans, and everything lined up, and he was going ahead. And then, as the year progressed, money became a little concerned and worried and backed out of supporting him. And then he knew that if he failed, it would be a disaster. He even tried to get through to the head of the Bank of England to do a special bailout, and the bank wouldn't move to rescue him. But anyways, when the market crashed in England, it was explained as being caused by Hatchery. So, no, the problem with the great financial boom, and this is what overwhelms the central bank as a lender of last resort, is not just one company that goes bad. Everybody goes bad at the same time when it happens. But again, thanks for the question.
Bob, for me, it reminds me back in the 20s, the you can't miss stock was RCA, the Radio Corporation of America, because radio for the public had just been invented, and everybody thought everyone's going to be buying a radio from them. You can't miss with that stock. Does that remind you of the high-tech crash, the dot-com bubble back in 2000?
Oh, radio, RCA, that's where the Kennedy family, Joe Kennedy, the patriarch, made huge money, and they put it together with, it was radio, it was phonographs, it was records, it was movies, and fabulous stuff. And at the peak, they were estimating, I think, something like $3 a share earnings, and then crash, everything went down. But there were because it was a big liquid stock, so there were big investors buying it as well, and all on the wonders of what was going on with radio broadcasting, records and gramophones and stuff like that, movies. And then, bang, it all went to hell, and the stock crashed from 125 down to $2 or something like that. Earnings disappeared, and they didn't get, I always like this because I did the research on it years ago, Jim, and they didn't get back to that $3 a share earnings estimate until 1956 or 57, and the success of that earnings recovery was based upon Elvis Presley. And in 1929, nobody knew about Elvis Presley. So, anyways, RCA is a particularly good story and a particularly wonderful crash, and everything changed. And by the time they got back to the earnings estimate, it was a different era, a different decade, and everything different. So there will be the equivalent sort of thing here coming up.
Yes, Elvis, all shook up for the markets there.
Yes.
Cecil or Cecil, depending on how you want to pronounce it, asks Bob, if bond yields are at their lowest levels in history and are expected to rise perhaps drastically if either inflation picks up or a market crash, then how are gold and gold stocks going to do well? Doesn't gold decline with higher yields? That's the explanation being given by most analysts now. How do you view this? Do you expect high yields over the next few years, and do you expect that will still correspond to a strong gold market?
Yeah, Cecil, that's a good question. The mainstream gold bugs need to do more thorough research. And what you want to look at is the real price of gold in senior currency terms as deflated by the CPI. And you also want to look at real long interest rates. And in a financial boom such as we've been in, real long interest rates decline with the boom. Now, with long treasuries nominal rates increasing, the real rate is turning up, which is what you would expect in the post-bubble contraction. And already the real price of gold has gone up ahead of time with this. But what you find is that in a financial mania, real long interest rates go down and the real price of gold goes down. And then when the bubble is over, then the real price of gold goes up, already with a good uptrend, and then real long interest rates go up, which may be starting. We don't know. So the problem the regular gold bugs have is that they start taking a look at the dollar price of gold and nominal interest rates, and it's a dead end. It just gets screwed up. But it's not just your gold bugs. I remember talking to a guy years ago, a major gold trader in London, and he was the same thing, that if interest rates go up, you got the carrying cost of gold and da-da-da-da-da-da. And no, we'll stay with history that the real bull market for gold's real price is well established, and it will likely be accompanied by real long interest rates going up. And I'll leave all the gold bugs to do a little more research.
A question from Butch. Everyone is saying buy hard assets, real estate, metals, art, etc. due to the money creation and low interest and no confidence in government. I tend to agree, but I am worried too many are agreeing to this, just like an overcrowded trade.
Yeah, Butch, it is an overcrowded trade. Yeah, everybody's on the bandwagon that inflation is, 1970s inflation is going to come back. The Fed will even be more reckless with the socialist administration in the States, and yeah, everything's going to be more reckless. But if inflation, CPI inflation, was a threat to really be soaring, then the Treasury bill yield, the 6-month or the 3-month yield, would be going up. Hey, they're both going down. So what is more sophisticated, the money market or the touts about inflation and gold, where, as I've pointed out, the gold bugs and particularly the silver bugs still haven't done enough research to understand the key to what's happening now is that we're in a financial mania, and as I've said to other questions, when the financial mania is over, everything gets to deflate. So we'll watch for that. But actually, it's a good question. I like your Butch, the overcrowded trade. I think it's a good way to put it.
Bob Hoye will take a look at some headlines today when we return.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, the borrowing binge has really hit its riskiest highs for companies. Why are they borrowing so much money now? Do they have to?
Yeah, I always put in a headline. If it's a financial headline that's got binge in it, you got to put it up as a collector's item. And yeah, it's a fad. It's a mania to be whatever game your company is in is going to do very well, and if you can leverage up against it, all the better. So, and of course, the central bankers are being extremely accommodative because the damn fools have they've used their reserves instead of having their reserves in the most liquid item, which would be treasury bills or gold. Many central bankers, staffers have been practicing modern portfolio theory and putting money into equities. So, this is where you now have, not a gold standard. And I remember Jim Grant at the Interest Rate Advisor a couple of decades ago, he called it the PhD standard, where you had so many PhDs at the Fed, and they were then figuring out what the curve should be. But now it's the S&P standard. They're going to try and keep the S&P up as best they can. And but what is really behind this is that there's a rage to get exposed, and there's a rage by central bankers to accommodate whatever going on. And this, of course, will be drastically changed when Mr. Margin gets to work, and somewhere he will become effective.
Your comment on the PhD economists. I remember the joke, an economist is someone who has never met a regular person, but they've had one described to them.
I'd never heard that one. That's a good one. Yeah.
Unprecedented. Millions of GameStop shares failed to deliver during the big squeeze on shorts. What happened there, Bob?
Oh, that, as we and the whole street knows, was one of the greatest short squeezes in history. Absolutely huge in dollar amounts, and then also in price changes as well. But there must have been many undeclared shorts there. So I'm all for shorting. That adds to liquidity. You short on the uptick, and you make sure you board the stock at the loan post to do it. But this thing, of course, was so crazy. Then the delivery failures is, I don't know how the hell the back office is going to sort that one out, but people were probably undeclared shorts, and what the price was in covering and sorting it out. I think it's probably just an immense accounting disaster now. And I guess from time to time there'll be stories coming out on some of these things, and we'll be watching for them.
The world's largest fund manager says he's now dabbling in Bitcoin. How safe is your money in his hands?
Oh, my God. You know, after it's come so far, and the way it was phrased, like we've just begun to dabble in it, like, oh, this is kind of beneath us, but hey, we're going to get in anyways. And always a dangerous sign, I guess, Jim. But it was again reflecting the highly speculative nature of the financial markets and of central bankers and of, in this case, it was listed as the world's biggest fund manager. I didn't catch the name on it. I just wrote the headline. So remarkable times, and the excesses are getting extraordinary. And the conviction here now, Jim, is that the street thinks that all these prices going up, and now they've added commodities to it, that it's a direct result of the Fed going to be pushing money up out the window. But sometimes you want to step back and look at it from the other direction, which is that in a wild market, you have speculators leveraging up, and they then are effectively, rather than the Fed accommodating speculators, it's the speculators that are accommodating the Federal Reserve. They're allowing them to expand their portion of the credit market. And then in the past, you've always had these credit contractions. And we know that following 1929, the Fed was buying bonds out of the market, and it wasn't doing anything, because you've got that editorial in Barron's from July 1932, which was actually the bottom of the first bear market there, and they pointed out that every anti-deflationary measure taken by the Fed is not working. And the editorial adds that the anti-deflationary measure was buying bonds out of the market. So the economists worked very hard to overlook that the Fed was remarkably easy all the way down that contraction. And I think the same thing's going to happen here, but what happens is the hottest prices exhaust themselves, roll over, and then eventually there is enough sectors heading down that then the power switches from the central bank to the margin clerk. And he's got his job description is very clear. Get the accounts in line. And today with modern central banking, it's the opposite. They want to get the accounts out of line and highly leveraged. So it's going to be an interesting struggle, and it'll show up in the technical markets, which we are getting excesses now. So we'll be watching it rather closely.
Bob, thank you so much for being on the show and answering all those questions from our listeners.
Well, the team of questioners had some good questions and to the point rather than essays, so it's always fun to deal with them.
Bob loves to answer your questions. You can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.